Hi friends, today we are going to see about the risk and return, right? In the second unit, we are going to discuss on the risk and return. So we'll be discuss the different concepts about the investment mode and the National Stock Exchange, BSC, and other information in the first and second unit. The second part of the our second unit, we are going to discuss on the risk and return. So we know that there are different motives for investment, right? Motives for investment. We already discussed it several times. The main motives for the income is a return is a regular income. So the investor want to get a regular income for their investment. So the regular income either in the form of dividend or it may be in the form of interest. Okay. So dividend or in the form of interest, maybe bond and other type of government instruments, the investors will receive in the form of interest. Okay. And the second motive behind any investment or return is capital gain or capital appreciation. Okay. Capital gain or capital appreciation. And the third important motive is we discussed in the first unit itself, hedge against inflation. So the positive real rate of return, the hedge against the inflation. And very important, the investor also look on the safety. The investor will also look on the safety. And finally, liquidity of the investment, whether the investment will provide the liquidity in terms of easy return or in terms of easy availability of the funds whenever the investor is required, right? So this is the very important thing you just note out. And just a second. Okay. Come to our discussion. The regular income, capital gain, hedge against inflation, safety of funds, or liquidity and marketability of the investors. So when we discuss on the return, very absolutely we want to know the formula for the return. Okay, so total return is equal to cash payment received, cash payment received, cash payment received during the period, cash payment received during the period, plus price change, price change over during the period, cash payment received during the period, price change over the period divided by price of the investment, price of the investment at beginning, price of the investment at beginning. Or I will tell you there is a one more formula for better understanding. So total return is equal to income received, both are same, right? Both the formula are same. Income received plus price change divided by purchase price of asset, purchase price of the asset, purchase price of the asset, that is at the beginning, right? Purchase price of the asset, both the formula are same. In our easy understanding, in terms of the formula, I will explain you. R is equal to C plus PE minus PB divided by PB. So here R is, dear students, please write out, R is total return over the period. R is a total return over the period. C is cash payment received during the period. Please write out. R means total return over the period. C means cash payment received during the period. Cash payment received during the period. PE stands for ending price of the investment. So this one, okay, PE stands for ending price of the investment, and PB stands for beginning price. Again, I am repeating, R means total return, C is a cash payment received during the period, and PE stands for ending price of the investment, and PB is a beginning price of the uh, particular stock or any investment portfolio. We can discuss with one important exercise, right? Important exercise. Assume that price at the beginning of the year. Price at the beginning of the year. If you take any stock, right? If you take any equity shares, price at the beginning of the year, maybe assume that we consider about 70. And dividend also the particular company has paid to the shareholders. Dividend paid at the end of the year is rupees 5, and price at end of the year, price at end of the year is rupees 80. So price at beginning 70, dividend paid is 5, price at the end of the year is rupees 80. Then how do you calculate the return? How do you calculate the return? Return is nothing but, okay, return is nothing but, so 80 minus 70 plus 5, okay? So the price appreciation, right? Divided by 70, price at the beginning. So which means, so 10 plus 5, 15 divided by 70, you may get, I think, a 0.214, or we assume that 21 percentage, 21.4 percentage is a return. 21.4 percentage is a return. So this is the way you have to calculate the return. Okay, this is a very important point, you just note out. And come to the risk. Okay, we are discussing on very important part of our discussion, risk. So normally risk will be classified into systematic and unsystematic risk. Systematic and unsystematic risk. Systematic risk and unsystematic risk. So what is systematic risk? So dear students, systematic risk, which refers the portion of the total variability of the return. Okay, again I am repeating, the systematic risk which refers the portion of the total variability of the return, total variability of the return caused by common factors. Again I am repeating, systematic risk means it refers the portion of the total variability of the return caused by common factors, caused by common factors, caused by common factors. And unsystematic risk means which refers the portion of the total variability of the return caused due to unique factors. Okay, unsystematic risk means which refers the portion of the total variability of the return caused due to unique factors. So previously the systematic risk is caused by common factors, and unsystematic risk it is caused by the unique factors. So my dear friends, in simple form, I can explain you the systematic risk. Okay, the systematic risk, please write down, the systematic risk is a external and uncontrollable factors. Systematic risk is a external and uncontrollable factors. External and uncontrollable factors. And unsystematic risk is a controllable factors. Okay, controllable factors. Unsystematic factor is a controllable factors. Controllable factors. This is uncontrollable factor, systematic, and unsystematic is a controllable factors. So now we will discuss what are all the systematic risk. Okay, what are all the systematic risk? Systematic risk includes market risk, okay, market risk, then interest rate risk, market risk, interest rate risk. Please write out market risk. Market risk means we know that changes in the market conditions. Changes in the market conditions. Second one is the interest rate risk. Changes in the interest rate. So we know that RBI is every year, during the monetary policy revision, the RBI or Central Bank of India will regularly changing the interest rate for different securities and bonds and etc. Then come to the third one is a purchasing power or inflation risk. Purchasing power or inflation risk. Purchasing power or inflation risk. And come to the last one is a trade cycle or business condition. Trade cycle or business conditions. Trade cycle or business conditions or monsoon, right? Or monsoons for agriculturally based economies like India. Even business cycle or monsoon factors. So these are all some unsystematic risks. Sorry, not unsystematic, systematic risks. That is external factors, uncontrollable risk. So come to the examples of this unsystematic risk. Come to the examples of the unsystematic risk. First one is the business risk. We can control, right? Systematic risk is unsystematic risk is a controllable risk. Business risk maybe relating to any industries. Then financial risk that also we can control. Financial risk due to heavy interest burden or inefficient capital management, etc., etc. Financial risk. Then management risk that also we can able to control. Management risk maybe due to poor efficiency, planning, etc., etc. And the fourth important one is labor and other input risk of the company. Labor problem, right? Labor risk, right? Labor risk, input risk, etc., etc. So these are all the unsystematic risk. So, okay, now, so what is risk, right? What is risk? And return, we know that return is any form of investment which have received the form of capital appreciation or a dividend or it may be a profit. We call it as a return. Okay, there are return is measured. Return is measured by taking the income plus price change. Okay, return is measured by taking the income plus the price change, and income is either in the form of dividend or an interest or price change, or it may be a capital gain. Again, I am repeating, return is measured by taking the income plus the price change. Return means it is measured by taking the income plus the price change. Income plus price change. And the risk, income means either dividend or interest or price change of the security. Price change of the security. Then we discussed on the formula how we can calculate for the return formula, how we are going to calculate the return formula. And then we discussed on the different risk. So risk actually it is an systematic and unsystematic risk. We know that it something is uncertainty. Risk is something is an uncertainty. We call it as a risk. Okay, something which may be uncertainty happen in the today's business. We call it as a risk. Okay. So actually, the risk may be the different forms: systematic risk and unsystematic risk. Systematic risk is external factors, and unsystematic risk is a specific or unique factors. Okay. And we know that interest rate risk, purchasing power risk, internal business risk, external risk, etc., etc. We have discussed. The financial risk in the unsystematic risk may be variability of the income, dividend, EBIT, etc., etc. Are having the different opinion on the risk parameter. Well, come to our discussion. The return, right? Sorry, risk. What are risk is a uncertainty go together. Risk is a uncertainty go together. We know that. What causes the risk? Okay, what causes the risk? What causes the risk? We know that there are different factors which causes the risk. What causes the risk? Wrong decision. Okay, the very important one is a wrong decision. I can write quickly. Wrong decision of what to invest in, right? What to invest in, and wrong timing of the investment. Sometimes the people will invest money when the stock market is boom, they can sold the share, and when the stock market is not in a good condition, they will not buy, they will sold it in the market. But normally when all the people whoever earning an income in the stock market, they advise you, whenever the stock market is a fall, whenever the stock market is facing a fall, it is a correct time for investment, a correct time to enter in the market. Wrong timing, wrong timing of investment. Nature of the instruments. Okay, nature of the investment, nature of the instruments. Maybe we are choosing the different categories based on the risk and return profile and liquidity and safety profile as well as age profile and credit worthiness of the issuer, credit worthiness of the issuer, credit worthiness of the uh, issuer. Then maturity period, there are another important factor. Maturity period is also we want to look at. Amount of invest, how much we are going to invest. Then method of investment, okay, collateral or not. Okay, amount of investment, method, right? Method of investment, terms, method of investment, terms of investment or terms of lending. Okay, terms. Then nature of the industry, business in which the company is operating. Suppose when we talk about I am investing my money in this automobile sector, then we want to look on the factors which pertaining to the automobile sector and the national and international factors. Okay, national and international factors. So these are all national and international factors. Okay, nature of the industry, nature of the industry. Then we also look on general fundamental factors, or we call it as a national and international factors. National and international factors. So these are all the causes of the risk. So risk is any investment which may be given some uncertainty in the market. We call it as a risk. So risk used to comprise all elements of variability of return, uncertainty of the outcome. Some risk may be a controllable and some risk may be a not controllable, right? So we discuss systematic and unsystematic risk. So come to our important discussion, how the risk will be, risk and return will be for a different portfolio of the investment. So while consider this is the diagram, right? This is assume that this is X line and Y line, and you take this is a risk taken and this is a return. And I'm just drawing that here. You just check here. Here is a insurance scheme. Low risk, low return, right? Then bank deposits, post office again, post office deposits, moderate risk, moderate return, mutual funds, again moderate mutual funds, mutual funds, then debentures, equity, high risk, high return, then finally derivative, even finally venture capital funds, venture capital funds. So this is the risk and return. Okay, this is the risk and return factors. Okay, So based on the risk and return, the different investment modes will be discussed here. So next important topic we are going to discuss today is CAPM. Hope you may studied in your financial management second trimester. So CAPM means capital asset pricing model. CAPM uses the concept of beta to link risk with return. So concept of beta, okay, CAPM uses the concept of beta to link. Okay, beta can be used for link risk and return. Link risk and return. So this is the main purpose that we are using the CAPM model for any calculation of the equity. So using CAPM, investor can assess the risk return. Okay, using the CAPM, the main objectives of the CAPM model, the investor can assess the risk return trade off. Risk return, please write out. The main objective behind the CAPM model is risk return trade off. And I will tell you the formula for CAPM RF, not sorry, not RF, RI, okay, RI is equal to A plus beta I and RM. Here RI, please write out. RI means estimated return on I stock. Return. RI means return, estimated return on I stock. I is a one stock name. Okay. And A is expected return. A is expected return. Expected return when market return is zero. Expected A is a expected return when market return is zero. And beta I, okay, beta measures the stock sensitivity to the market index. Beta is a measuring stock sensitivity to the market index. Okay, and RM return on market index. Return on market index. So beta is beta measuring stock. Measuring stock. So this is the formula for calculation of the beta. This is the formula for calculating beta. Okay. So the equation for calculation of beta is Ri is equal to A plus beta I Rm. So using the beta concept, the capital asset pricing model will help to define the required rate of security. So now I can explain you the formula for measuring a CAPM model. Okay, CAPM model. Ri is equal to Rf plus beta 1 Rm. M means market risk. Then Rf risk free. Normally risk free we consider the government securities, treasury bills. Okay. And Ri is the required return. Ri is the, please write out, Ri is the required return and RF is the risk-free return. RF is the risk-free return. So normally 3%. In India, it is 3% or maximum 4% based on the treasury bill return. Treasury bill or government securities, bonds or any other, we consider as a risk-free rate of return. And RM is the average market return or Sensex return or Nifty return. Assume that's market risk, market return. And beta is the measure of systematic risk. Beta is the measure of systematic risk. Okay, measure of systematic risk. So now I will tell you one important observation to you. If you take risk-free return is 12 percentage. Okay, normally it will not given the risk-free rate is a 12 percentage. Assume, okay, for example, I am telling the risk-free rate RF, okay, RF will 12 percentage on treasury bill rate or bank rate, and market return, right? Market return is 18 percentage. Market return is 18 percentage. And let us take a beta is 1.2. Okay, 1.2. Then how do you calculate the return? So return is equal to 0.12 plus 1.2, and RM minus RF is nothing but 0.06. That is 18 minus 12. So now you will get 19.2 percentage. This is the CAPM model. This is a CAPM model. Okay, CAPM model. Normally CAPM is a capital asset pricing model. Capital asset pricing model. And the capital asset pricing model is uses the concept of beta to link the risk with the return. So using a CAPM, the investor can assess the risk return trade-off involved in any investment decision. Okay, and one more concept called uh, just a second. One second. SLL, security market line. This is the final presentation on today's session. Security market line. SML, security market line. Security market line. So here, capital asset pricing model is drawn graphically. See, assume that, okay, assume that this is the formula, and this is, sorry, there is x-axis and y, risk is beta, okay, and assume that this is called as risk-free rate of return, risk-free return. So this is 12, right, based on our exercise, and this axis is called return. Okay, so normally this is an SML diagram. So when the capital asset pricing model is drawn graphically, this is a model we have drawn in CAPM. We get the SML line. We get the SML, which is shown in the chart, right? Normally, we know that this is the risk, right? This is a risk, 0.5, 0.1, like that. So when we draw in capital asset pricing model, is drawn graphically, we will get a security market line, which is shown and explained in this graph. If the investor want to decide on an investment with an expected return, he would know the level of risk. Okay, please listen. If the investor want to decide on an investment with an expected return, he would know the level of risk. He would know the level of risk. If you take, he has preferred to take the risk, he would know the expected return from this chart. So if this level risk and how the investor can behave. See, so this is a risk return, risk-free return, right? And if the risk is increased and the return also increase, so 1.5, right? That is the meaning. So the investor has to assess whether it is worth taking to level of risk if he has target return which involves the risk. It is assumed that generally risk averse. CAPM and SML help the investor in evaluating the risk and return. So SML and both CAPM, they measure to know about evaluating the risk for a return. Evaluating the risk for a return. This is the main objective of the CML. Okay. Risk in relation to portfolio are also understand. So portfolio, we know that it is a combination of securities. So if you take example, the risk in two major models used to discuss whether it is a systematic or unsystematic can be also helpful for measuring the risk. So normally security market line, it is a investor evaluating the risk and return. Investor evaluating the risk and return. And while drawing the capital asset pricing model itself, we may know the detailed concept on security market line. So security market line is the representation of the capital asset pricing model. Again, I am discussing, my dear students. So it is measuring the representation of the capital asset pricing model. It displays the expected rate of return of an individual security as a function of systematic non-diversified risk. So SML is equal to expected return is equal to RF plus beta I, that is expected RM minus RF. This is a formula. ER is an expected return. RF, you know that risk-free rate. RM is expected return on market portfolio. Beta is non-diversifiable or systematic risk. And RM is market rate of return. Assume that, again I am explaining the diagram. Previously we explained with the CAPM diagram. So this is a security market line. Security market line. So this is a risk, systematic risk. This is a systematic risk. Okay, this is a systematic risk. This is risk-free rate. And assume that this is a point. Assume this is a 1 is a systematic risk. And expected RM is like this is a market return. Market return. Okay, and this is ER, expected return. So these values, okay, these stocks, normally these stocks are called as above the market return, above the Sensex return or Nifty return. If any stocks are providing highest rate of return, that is sorry, this is above that. Here it is called as a overvalue stock. And this one is an undervalue stock. Okay. So mostly some stocks are not that much of par with the price, and some stocks are not. They are trading on the highest price. Okay. So this is systematic risk and unsystematic risk can be discussed with the help of SML. Okay. So thank you, friends.